Welcome to the Deep Dive. Today we're taking a close look at the global economy. It's pretty dynamic, often surprising, and we're zeroing in on global markets as of, well, mid-July 2025.
And we've got the latest updates, fresh data, fresh insights.
Exactly. Our mission, like always, is to give you a shortcut, a way to really get your head around the complex forces at play right now. We're going to unpack how recent events and, especially the talk about escalating tariffs are sending ripples across different economies.
Right, from the big advanced ones like the U.S. and Europe.
All the way to key players in Asia, and even hitting the oil market, which is always, volatile.
Mm-hmm.
This deep dive, it's really designed to help you connect the dots. Trade, inflation, policy, see how it all fits together.
And tariffs, they're really front and center now, aren't they? The data shows they're not just background chatter, they're a key driver.
A real driver.
Yeah, we're seeing early signs, actual concrete signs of how they're impacting everything. Consumer prices, sure, but also national budgets, even international relations.
So today we're distilling that down.
Exactly. Finding those essential nuggets of knowledge for you, helping uncover those deeper connections.
Absolutely. And you're going to hear some pretty eye-opening stuff. I mean, tariff revenue figures in the U.S. that are just, wow.
And some GDP numbers out of Asia that maybe weren't expected.
Right. Plus these intriguing political undercurrents swirling around trade, around central banks.
Oh.
Okay, let's unpack this, because what's happening right now is incredibly insightful. Let's start our deep dive then in the advanced economies. The U.S. first.
Makes sense.
Okay, so the June 2025 inflation data. It showed early signs of what our sources are calling tariff-induced price pressures, specifically on consumer goods.
Mm-hmm.
The headline CPI, it rose 2.7% year-on-year, core CPI, up 2.9% year-on-year. What was behind that push?
Well, a lot of it came from imported consumer goods, stuff like coffee, electronics, furnishings.
The imported items specifically.
Exactly. And it's an interesting contrast, actually, because other things like lower vehicle prices and pretty limited price hikes for services, think airline fares, hotel rooms, they actually helped keep underlying inflation sort of muted. For now, anyway.
Okay, so those inflation signals, even if a bit mixed, how did the markets take it? What did investors do?
Well, you saw treasury yields tick up and the dollar got stronger. That usually tells us investors were pulling back.
Yeah, paring back their expectations for Fed rate cuts.
Fewer cuts expected.
Right. And significantly, the political side got louder, too. Reports mentioned President Trump criticizing Chair Powell again.
Oh, what was the issue this time?
Citing cost overruns at the Fed's headquarters, calling it a potential firing offense. Now, it's important we state we're just reporting what's in the source material here, not taking sides or endorsing that view.
Understood. Just laying out the context. So amidst that, the administration's tariff stance, described as increasingly aggressive.
Yes, and this is where it gets really interesting. June 2025 saw a stunning 301% year-on-year surge in customs duties collected.
301%. It's a huge number.
And it actually pushed the federal budget into a surprise surplus for that month.
That's right. The sheer scale is pretty significant. Annual tariff revenue hit USD 113 billion.
Wow.
And some projections are looking at maybe USD 300, even 350 billion by the end of the year.
So what's the implication here? Is this just about negotiation leverage anymore?
Well, that's the key insight, isn't it? It seems to signal a potential shift. Maybe tariffs aren't just a negotiating tool now, but are being treated as a, structural source of fiscal revenue.
A way to fund the government?
Potentially. And if that's the case, it could really fragment global supply chains long term. It forces countries to rethink their whole trade strategy, maybe even how they fund their own budgets. It's a fundamental question.
That does reshape things.
Yeah.
Okay, so with the U.S. taking this stance, how did Europe react? They're a major trading partner. Trump threatened 30% tariffs on the EU, right?
Right. Yes. And the immediate market reaction. The euro dropped to a 3-week low.
Okay.
The European Commission, publicly, they reaffirmed they want a negotiated settlement, but they also extended the suspension of their own countermeasures into early August.
Buying more time.
Essentially, yes. Kicking the can down the road a little, hoping for a diplomatic solution.
It's just so many forces converging. Let's shift gears a bit. Energy. Oil prices.
Always a factor.
Sources say they fluctuated as traders weighed, the risk of new U.S. sanctions on Russia against signs of ample global supply. How did that play out?
It was a real tug of war. You saw Brent crude, it popped above USD 70 early in the week.
What caused that spike?
That was after President Trump announced sending Patriot missiles to Ukraine and said he'd make a major statement on Russia. So naturally, speculation about tougher sanctions on Russian oil exports heated up.
Right. Sanction fears drive prices up.
But then prices eased back later. Markets digested this 50-day deadline Trump set for Russia to reach a peace deal, or else face secondary sanctions on oil buyers.
Ah, so the deadline actually calmed things. A bit counterintuitive.
Well, it raised hopes that maybe major supply disruptions could be averted, at least for those 50 days. It shows how sensitive the market is to potential future supply issues, not just current ones.
Interesting. And on the supply side itself, you mentioned ample supply.
Yeah, fresh data showed Saudi Arabia actually exceeded its OPEC plus quota in June by over 400,000 barrels per day.
That's quite a bit over.
It is, and that definitely played a part in keeping a lid on prices. Even with all the geopolitical noise, that physical supply cushion was there.
Okay, so let's pivot to Asia now. These economies are obviously tied into global trade, energy. How are they navigating these trade winds? Let's start with China.
Okay. China showed a pretty stable growth trajectory in Q2. GDP up 5.2% year on year.
Which keeps them on track for their target.
Looks like it. Sources say it lays a solid foundation for meeting the government's 5% full-year goal.
And their trade data, given all the tensions.
Surprisingly resilient, actually. Exports rose 5.8% in June. Now, that was boosted by stronger shipments to Southeast Asia and the EU.
So diversifying away from the U.S.
Seems like it. Exports to the U.S. did decline for the third month in a row, but those other markets picked up slack. Also, interestingly, rare earth exports surged.
Really? By how much?
Over 60%, apparently aided by some easing of U.S. tech restrictions and Beijing issuing more export licenses.
Yeah, the imports.
Imports were more modest, up only 1.1%. Domestic demand, maybe not quite as strong. So that led to a sharp jump in the trade surplus, USD 114.8 billion for June.
Okay, quite a surplus. Now, Singapore. Their economy apparently surprised on the upside.
Yes, Q2 GDP expanded 4.3% year on year, better than expected.
What drove that?
Couple of things. A rebound in manufacturing and also what sources called front-loaded exports.
Seeing.
Firms basically rushed shipments out the door, trying to get ahead of any potential new U.S. tariffs. Smart move, maybe.
Get it out while you can.
Pretty much. Plus, construction was robust. Tourism-related sectors did well, too.
But are policymakers confident?
Cautious. That's the word used. They kept the official 2025 growth forecast quite wide, 0 to 2%. Still worried about global uncertainty, especially if trade frictions get worse.
Right. That caution makes sense. Okay, next door, Japan. Described as having mixed data, exports fell again.
Yeah, second straight month, down 0.5% year on year in June, led by sharp drops in shipments to the U.S. and China.
And that puts pressure on key industries, like cars.
Oh, absolutely. Big pressure on automakers, industrial exporters, because the U.S. is threatening that 25% blanket tariff on Japanese imports by August 1st, unless they strike a deal.
Another deadline looming.
Exactly. There was a tiny positive sign imports ticked up slightly, maybe hinting at some modest domestic stabilization. But the overall picture looks challenging. Weak household spending, those export headwinds. Japan might struggle to regain momentum if those trade talks falter.
Okay, let's move south. Thailand.
Yeah.
Investor focus there was on a beloved appointment.
Yeah, the next Bank of Thailand governor, Vitai Ratanakorn, was seen as the frontrunner.
And the market expectation.
That he'd bring a more dovish monetary stance, more coordination with fiscal policy, too.
So markets see him as likely to ease policy.
Largely, yes. Interpreting his potential appointment as a signal for more accommodative policy, which could help keep shorter-term yields down.
But there are concerns.
There are. Underlying worries about institutional independence and the fact that the broader macro indicators are still seen as a bit fragile, especially with external pressures and, domestic political noise.
Right. Okay, finally, let's look at Malaysia. Started the week cautiously. Why? Trump's threats again.
Yes, described as Trump ratcheting up trade measures on every country globally. That general uncertainty hit sentiment.
How did the market perform?
Well, the main index, the KLCI, closed down 0.7% for the week. But interestingly, the broader market actually held up better than the big blue chip stocks.
Any specific sectors doing well?
Construction was strong, up over 3%. Energy, property, industrials, telcos, utilities also gained. But foreign investors were net sellers.
How much selling?
Net sold about RM 425.86 million worth of equities. So some caution from foreigners.
And the economic signals from Malaysia. You mentioned mixed signals earlier.
Right. The Industrial Production Index, the IPI, that slowed quite a bit in May, only up 0.3% year on year, below what people expected. Mining output was the main drag.
Okay, so that's the weak signal. What was the positive surprise?
The advanced Q2 GDP estimate came in at a strong 4.5% year on year.
Better than expected.
Yeah, expectations were closer to 4.2%, so that was quite good.
What drove that stronger GDP?
Mostly strong consumer demand. That helped offset the weaker export picture we saw in the IPI data. The services sector got a boost from things like a public sector pay raise, school holidays, seasonal spending.
Internal drivers helping out.
Exactly. Agriculture, manufacturing, construction also showed growth. So some resilience there on the domestic front.
But even with that good GDP number, you said uncertainties persist. Short-term headwinds.
Definitely. Our sources point to a few key things. That U.S. 25% tariff negotiation deadline, also August 1st for Malaysia.
Same as Japan.
Right. Then there's talk about potential U.S. restrictions on AI chip exports to Malaysia, plus the renewed foreign selling we saw, and just a general lack of fresh positive catalysts right now.
Yeah, domestic headwinds, too.
Yes. The planned sales and service tax, or SST, expansion in the second half of the year, plus electricity tariff rationalization, those could potentially weigh on consumer spending and make corporate earnings harder to predict.
Okay, quite a few things to watch there. Also, a quick note on their bond market.
Yeah, the Malaysian government securities market, MGS, traded slightly weaker, but a new 30-year MGS issue saw healthy demand, a good bid-to-cover ratio, so still appetite from the long end.
Okay. So let's try and bring this all together. We've covered a lot of ground. What does it all mean?
Well, I think the core takeaway is that the global economy is really in a delicate balance right now.
Delicate, yeah.
U.S. tariff policy is clearly acting as a major disruptor. It's creating these surprising financial shifts like that budget surplus from duties, but also just persistent uncertainty across the board for everyone.
Affecting all these major economies we've talked about.
Exactly. And by connecting these dots, linking U.S. inflation and the politics around the Fed to what's happening with Asian trade balances or swings in oil prices, you start to get a much clearer picture.
You see the interplay.
Right. You see the complex forces shaping the markets, and you also see this blend of resilience in some areas, like maybe China's exports or Malaysia's domestic demand, but also a lot of caution everywhere.
Definitely a mix of resilience and caution. Okay, as you, our listeners, go about your day, here's maybe a final thought to mull over, something that really struck me from the sources.
Go on.
Given this potential shift we discussed, with the Trump administration maybe seeing tariffs not just as a negotiating tactic, but as a structural source of fiscal revenue, what are the real long-term implications of that? How might that change how countries structure their trade relationships, maybe even their national budgets, for years, maybe decades to come? Could this fundamentally reshape global economic alliances and where supply chains actually run?
That's a huge question. Really makes you think about the future structure of the global economy.